According to an AARP survey conducted earlier this year, 1 in 5 Americans don't have any retirement savings at all. In addition to that, half of those surveyed do not feel confident that they have enough to make it all the way through retirement. So, as a major advocate of retirement planning and financial literacy, I'm super excited to bring to you today what I would consider to be the core group of retirement plans that might fit into your picture. Hey everyone, Gabe Galanti here, fiduciary financial advisor and CEO of Rockline Wealth Management. So the first plan I want to talk about today is what I would consider probably one of the most common in being the 401k. The 401k is a retirement plan administered by employers for their employees. A few caveats to note here. Contributions are typically made on a pre-tax basis, meaning you receive a deduction on your income up front. The money will then grow tax deferred, and taxes will be paid on any withdrawals you make in retirement. In addition, some plans have a Roth feature, which allow you to make contributions after the money has already been taxed. Your earnings will grow tax-free, and then any withdrawals in retirement will be tax-free as well. With that, I have a few points to make you aware of. If you withdraw money prior to 59.5, you could not only face a 10% penalty, but if it's a pre-tax account, you will get taxed as well. You should also be aware of something called an RMD, or required minimum distribution. Currently, at age 73, if you are no longer working, you will be required to take a portion of money out of your 401k on a pre-tax basis, whether you need the money or not, which means taxes will hit. Now, let's talk about the IRA, or Individual Retirement Account. This type of account is available to pretty much anybody that has earned income, whether your employer provides a plan or not. Similar to a pre-tax 401k, a traditional IRA will allow you to make contributions that will lower your income for the year, in addition to allowing your investment to grow on a tax-deferred basis until you take the money out in retirement. There's also the possibility that you might have more flexibility over your investment options within an IRA as opposed to your 401k. A few items to be aware of that may not seem so advantageous. First being, the contribution limits are dramatically lower than a 401k. In 2024, if you are under the age of 50, you can contribute up to $7,000 on the year, and you can add an additional $1,000 as a catch-up if you are over the age of 50. Secondly, there are income limits which could prevent you and your spouse from deducting the amount off of your income for the year. And last, RMDs, or required minimum distributions, apply here as well. Whether you're working or not, currently in 2024, at age 73, you are forced to take money out whether you need it or not. As with the 401k having both a pre-tax and Roth option, so does the IRA. So let's talk about a Roth IRA. One of the major points to consider when thinking about the Roth IRA is very similar to the Roth 401k, is that contributions are made with after-tax dollars, your earnings grow tax-free, and withdrawals in retirement are tax-free as well. Another potential positive is that there are no required minimum distributions with Roth IRAs, so your money seemingly could grow as long as you want. One last tidbit that I think could be useful is that you can actually withdraw your contributions to a Roth at any time completely penalty-free. As is typical, with positives come potential negatives that I'd like to talk about as well. The first thing that you should know is that if your income is too high, you may not be able to contribute to a Roth IRA. Also, similar to a Roth 401k, you do not get a deduction on your income with the upfront contributions. My last two plans are for those of you who are self-employed or run a small business. And here's where you're going to see that the contribution limits are much higher. First, the SEP IRA. With a SEP IRA, you can contribute up to 25% of your income, up to $69,000 for 2024, which is huge if you want to contribute in an aggressive manner. The contributions are completely funded by the employer, which is you, if you're self-employed. As far as cost and complexity, the SEP IRA is rather inexpensive and relatively easy to set up when compared to a 401k. Like the other pre-tax accounts, you'll receive a deduction on your income for the year based on contributions made. Your earnings will grow tax-deferred, and you'll pay tax on the money when you take it out in retirement. And last is the solo 401k, an option for those of you that are self-employed with no employees. Some of the pros of a solo 401k include higher contribution limits. The contributions can come from both the employer and the employee, and you can contribute very similarly to a SEP at $69,000 per year for 2024. Next, a difference from the SEP is that you can also add a Roth feature. So if being able to contribute to a Roth is important to you, this could be a good choice to consider. Lastly, also different from a SEP, is that you can add in a loan feature, which allows you to take a loan up to $50,000 or 50% of your balance, whichever is less, over time. As always, I do want you to be aware of what could be considered a drawback of the solo 401k. When compared to the SEP IRA, setting up and managing a solo 401k could be a little more complex. It could require additional filings and paperwork, and therefore could have higher fees, again, when compared to a SEP. So there you have it. From employer-sponsored 401ks to IRAs to self-employment plans like SEP IRAs and solo 401ks, there are pros and cons to each. It's key that you speak to your financial and tax professionals to have a better understanding of which fits best in your overall plan. If you found this video helpful, please feel free to like and subscribe for more educational content like this. And if you'd like to learn more about how we work with our clients, please feel free to visit us at www.rocklinewealth.com.